The people have spoken. They want a boring REIT.
Oh, boy. Dang REITs.
Realty Income Corp. Let's hit those like buttons, guys. It's we only have 157 likes on 332. Let's tickle that like button. Make my little grundle area purr.
The ticker's O?
Oh.
That's pretty cool.
Why is that cool?
I don't know.
So what kind of real estate do they have in their portfolio? We got to get descriptions on here too. Real estate investment trust that invests in freestanding single tenant commercial properties in US, Puerto Rico, and UK. Oh, triple net leases. So what are triple net leases? There's two things, triple net and absolute triple net. Triple net leases, I buy the building, I buy the land, but the tenant is responsible for everything. So it's basically like they pay the bills like they own it, but I own everything and they just basically lease it from me. Absolute triple net is like they pay for everything, including like capital improvements and everything like that. But either way, you know, you'd have the question now. The question right now would be, where do you think the commercial market's going? Are people going to have more offices, less offices? Single tenant could be Walmart. It could be banks.
Yeah.
It could be Dairy Queen's Grill and Chill. Like the other day, I don't know.
That would be cool. We need one of those. Well, you're moving. Never mind.
Yeah, I'm moving soon. They were started. Okay, so let's look them up. Let's look at them. Market cap of $22.5 billion. PE of 57x. Profit margin of 24%. Check mark. Free cash from last year, $1.1 billion, which is surprising considering where the economy went. And a 5-year average of 943. So it seems pretty consistent. Now, guys, the reason people like REITs. Look at this little dividend yield of 4.5%.
Ooh.
Make note, guys. The dividend yield, it has to be, wait a second. To be a REIT, you have to pay out 90% of your taxable income as dividends out to shareholders. That's a big component of being a REIT.
Wow.
So that's why you shouldn't be scared of dividends paid are such a big chunk of free cash flow. Okay? Return on assets is garbage, 2%. But remember, real estate has depreciation, so it decreases the asset. Oh, actually, that decreases the income significantly. So look at the free cash flow here. The free cash flow last year was $1.1 billion. Let's see what their profit showed. $400 million. That's the thing about real estate investment trusts. There's a big depreciation expense. Where's depreciation? EBITDA is earnings before interest, taxes, depreciation, amortization was $1.38 billion, but after depreciation, $700 million. So that's $600 million in depreciation and amortization charges. Add $600 million to $400 million. What do you get? $1 billion. What was their free cash flow last year? About $1 billion. So the REITs can be skewed in their earnings. Their earnings can be skewed because depreciation is a non-cash expense. If you own a building and you buy it for $1 million, the government will let you depreciate right off 30-some thousand a year, 40-some thousand a year as an expense, even though you didn't spend any money. It's just about buying the building. They sit there and say, oh, over time, the building loses value because you have to replace things and all that stuff. It's just basically an accounting thing. So that's why you have to look at REITs that way. So let's look at revenue growth. 1.06, 1.65, check mark. And I like the fact they still had revenue growth even last year. Profit, 315 to 395. That's kind of weird. So their revenue is up about 60%. Their profit's up about 30%. Not even. 25%. Interesting. Shares outstanding. Now, again, with a REIT, I don't think this matters as much. 258 to 354. It's an X, but I don't believe it matters as much because of the fact that when people buy the REIT, I don't know how it works actually.
I'm not sure.
Yeah, I don't know how that works.
I'm not sure.
I'm not an expert in REITs. People think like, oh, real estate. I'm not an expert in it. Cash on hand, $1.15 billion. Current liabilities, $226 million. Insanely high cash on hand relative to expenses, which is great. Being a triple net lease, they don't cover all those bills. Those bills get sent to the tenant and they pay them, so it makes a lot of sense. Cash flow. Let's look at the cash flow, baby. $800 million, $1.1 billion. Check mark with steady increases. Now you want to make sure how much of this is because of buying new properties. This is one of the things you'll find in the 10K. How many properties are they buying a year? How many properties are they building a year, et cetera, to understand how much of their growth is because of new acquisitions or new building versus bumps in rent from existing customers.
I feel like REITs are very important to read 10Ks.
Yeah, you're probably right.
I mean, you need to figure out what they are, what they're doing, what they're buying.
What their assets are.
Yeah, I think they're very important.
Who are the tenants behind the single?
Exactly.
Are they Starbucks?
Yeah.
Are they McDonald's? I mean, guys, You'd be surprised. Starbucks leases are, they're not going to get paid big money for those things. Because Starbucks has a lot of options. They're going to be like, yeah, we're going to go here.
Yeah, we're going to go somewhere else, right.
I remember once a real estate guy who is now broke was bragging to me about how he had Walmart and Target and all these other companies begging him to let them. I'm like, they don't beg people to be put to put. And guess what? The deal never happened. They went under. The entire company went under. And I'm just like, these companies don't beg.
No.
They say, this is what we want. Do you want to do it? Nope. Okay, see you later.
Next.
We'll go find somebody else.
We'll go down here.
Yeah, we'll go somewhere else. We'll go to another spot. They have a certain model. If it doesn't fit their model, they're out. They don't even think about it.
Yeah.
There's no fighting over it. They just do it.
Right.
All right, so, and then the average over the last 5 years is about 940 million. 940 times 20. I don't think I'd give it 20 on this one, but that's 18.8 billion. Is that right? Yeah, I think so. 18.8 billion. What's the market cap of this company?
I don't remember.
Anyone? 22. So it's pretty close.
Okay.
Now, remember guys, the PE does not matter here because if you saw, I had $600 million in extra depreciation that I didn't need to include.
Right.
I do not include it. So the PE is going to be higher. If you ever get to see a PE in a REIT, sub 20, I take a serious look at it because they have so much depreciation, you've got to figure out why that is. So when you add that back in, their earnings last year were about $1 billion and before depreciation. It's about 22 times earnings versus 57 times earnings that we saw before. So don't look at the earnings on a REIT the same way you look at the earnings on Microsoft, the same way you look at earnings on Google. Totally different situations.
Different. Yeah.
So on this company,
to me, this is like analyzing bank, insurance company, something like it's different. It's not your typical looking at tech company or something like that.
Now the price of free cash flow is very high. But other than that, this doesn't bother me so much. This doesn't bother me so much. I look at this price of free cash flow and think, maybe I can wait a little bit, wait for that dividend yield. Because remember, when the stock price goes down, the dividend yield is going to go up. Because they're going to still have to pay that. They have to pay that money out. They have to pay that money out to their investors. So I'd be patient on this one.
Yeah.
All right, what do you think, Mo?
All right, from this side, so I wrote in here these two prices. 67, this is the high of the year. 57 is the low. So you can see that it's just kind of consolidated in this range all year long. Now, this is a great stock to show you the power of the 50% rule and this overhang. So all of this area is called overhang. And the 50% rule, for those of you that don't know, is basically when a stock drops in price, it tries to run back up. And when it gets to this peak, people that lost money there, they'll sell it because they'll say, I got 50% of my money back. Sell it. Price comes down. And it just keeps going over and over. CCL is a great example of 50% stock right now. If you're going to do something with this, just know that if you are in this, let's zoom in, your peak is really going to be around $67. It's $64.15 right now. So you're in that overbought range. It doesn't have much more room to go. Unless something comes out, and I don't know what can come out of a REIT, but big news, something, say this was a tech stock, that's what's going to push that thing through that resistance line that it's been fighting all year long. Same with CCL. Vaccine, cruising again, that's what's going to push that thing through that 50% rule. 50% rules are very, very powerful. When you get into that range, don't think that you're going to be the one that's going to get through that time. Just be smart, stick to your rules. When you hit the 50%, sell your shares.
Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.